welcome to another edition of Taking Stock. This is the show where we take stock of the week gone by and prepare you for the next trading week. I'm Sonia, SHENOY, and with me is ANUJ SINGHAL. We have a whole host of guests lined up as well. This week has been not too bad, frankly. In fact, the bulls would have taken this week with both hands. 7,700 is here on the Nifty. We consolidated and we had a lot of big moves coming in on individual stocks, whether it was PSU banks like Bank of Baroda, whether it was auto stocks like Eicher Motors. The run was quite good this week, and given the global context where we had a bit of weakness, our markets actually outperformed. Anuj, of course, for the fiscal, you can argue, you know, the Nifty was down 10%, etc. But the week has been a fairly good one.
Yeah, I don't think too many people look at what happened in the fiscal year, Sonia. But yeah, the week was quite okay. Towards the end of the week, I got a sense that now we could consolidate on the large cap side and see a bit of a mid cap outperformance. So that's something that you have to watch out for. The mid cap index was up about 1% this week, and a lot of mid cap surge. Sectoral moves were there this week. Sugar moved a lot. Tea stocks moved a lot of stocks moved. So let's discuss the market dynamics and some stocks to watch out for. First up, Andrew Holland joins us right here in our studios from Ambit Investment. Andrew, hi, good to have you on the show.
Thank you.
So our market has seen a big revival. To be fair, all global markets have seen that. We started a bit late post-budget, but what next? Do you think this liquidity-driven rally is going to continue?
It's a great question, actually. You know, there's two schools of thought. The liquidity-driven rally, the short covering, you know, we're probably at the end of that now. And if anything, we've gone from the depths of despair to kind of everything's okay again. But is it okay? I worry about what you know, the Federal Reserve Chairperson Yellen is doing. She's gone from, you know, hawkish to, you know, super dovish within 2 months. Trying to weaken the dollar. People are saying that's good for China because it's now a basket. But someone's going to hurt, and I think it's Europe that's going to get hurt in all of this kind of currency turmoil. The currency has appreciated, the euro has appreciated. So I think you're going to see the problems emanate from Europe now. But let's just look at some facts as well, despite, you know, the kind of calming of market nerves. South Korea's exports in March are down 20%. Industrial production in Japan is down 6%. So something's not working somewhere. China is obviously, the economy is not picking up as people would have hoped, and therefore commodity prices have come off from their highs. So if the dollar gets any stronger because of maybe kind of weakness in Europe, that will cause commodity prices. And we'll go back to revisit the same problems we had in January and February.
Okay. Andrew, hi, welcome to the show. Let's talk a little more closer home now. You know, we did see some improvement in trends in certain sectors. Say, for example, the auto sector, where the month of March looked really good for certain pockets like commercial vehicles. Is that just a year-end phenomenon playing out? Is that an aberration? Or do you think that the worst is truly over for some of these pockets?
Yeah, no, I think it's a little bit of year-end buying, but also I think there are pockets of industries which are starting to do well. So the auto sector has picked up and maintained its kind of growth. You know, you're seeing it a little bit in cement as well, where cement prices are moving up. So there are areas, but you know, it's so patchy. You don't have the conviction to say it's going to continue because you know, I think the global factors, I know you want to go bring closer to home, but I think the global factors are still having to play out for us. And I don't think we're past that yet. I mean, obviously, we've got an event next week with the RBI. I think the market's already priced in 25. I think the hope would be now for 50, given what Yellen's been saying. But I think, you know, he might just keep at 25 just to be more cautious, because you've got an event coming up in the UK, obviously, with the will they or won't they stay in Europe.
Okay, that's of course the Brexit that's being discussed, Andrew. But you know, let's discuss the global markets a bit more. So, what's your reading of this fund flow situation? In the month of March, we got what, some 20,000 crores in equity inflows, and we saw that in the rest of emerging markets as well. Is this purely ETF-driven, hot money, tactical inflow into equities? Do you fear that that could get reversed, and is there a risk that the markets actually could go back and revisit their lows just to check, you know, if that takes support or not?
Yeah, so I'm not sure about the hot money part, but certainly as short covering came in quite considerably across, you know, global markets, and obviously, you know, the ECB and the Federal Reserve said put risk on, because we're not going to do anything. We're going to throw more money at the problem. in the very short term. So your risk trade came back on. But we're back to where we were, and we're still guessing, does the oil price go down? Does China, economy continue to head downwards, and will commodity prices fall? And I think if those three answers we had, I think we'd have a clearer picture. But the two things that concern me are, one, the ECB saying that inflation, which they were targeting only in December, 3 months ago, at 1%, is now 0.1%. And Yellen saying, I'm going from 4 rate hikes to 2. Within a matter of 2 months. I mean, those two things are telling you that there's something not right globally with the economy. And I don't think throwing more money is going to fix the problem. And so when we go back to revisit, if we do go back to revisit, the question that people are going to have is about the credibility of the federal or the central bank's ability to keep fixing the problem. And if we don't think that's going to happen, then the story will be very very bad indeed. So
if once again we do see a global-led sell-off in our own markets, do you reckon that the 52-week lows of 6,800 to 7,000 could hold? Is that a firm support for the market?
So the way I'm thinking about it at the moment is take a normal situation. I think if we look where the Dow is, and the P is about 19 again. If you put it more on a P of 16 with the earnings that people are predicting, then you're probably about 5% too high. So there's probably a 5% correction there. So we could see our markets do 5%. But if you go into revisiting all the problems of January, February, then you'll get taken much further down. So that will be a factor of that. So 5, 10%. 5% is a norm, and I think 10% could be what you could see. But I think what the RBI governor says as well next week will be very important for the markets.
Okay, so in that context, what about banks? We have seen a big rally in banks. PSU banks, of course, have rallied the hardest because of the valuation comfort. But even some of the beaten down PSU banks like ICICI have rallied. Is it good time to take some money off, or would you stay invested?
We've not really participated, to be honest. I mean, we're still uncomfortable with the banking sector as a whole. All of the problems haven't gone away, that's for sure, and they're still there. So again, because you had the risk on, they were all beaten down very, very badly. I'm not saying that they would be beaten down again so badly, but it's a risk. To buy now would be to me to put too much risk on to start chasing the banks at these levels.
Okay, so is there any pocket that would be insulated from the kind of volatility that we'll see perhaps in the next 3 to 6 months? Anything that you would still buy now?
See, there's the dilemma I have at the moment, actually, is where to hide. Because IT, I've said before, the decade of growth is behind us. And of course, with sterling, so weak, it's going to affect quite a number of the large IT companies going forward, or would have done last quarter. So I'm not sure that's the place to hide. Pharma is definitely not the place to hide these days, whether it's the US or the UK now in regulatory problems. And then you have, obviously, consumer goods. And again, with the recent rise in commodity prices, that's going to squeeze their margins. So, and the Ps are, are just too high to feel any comfort with. So maybe IT and a bit of consumer to hide in the very short term.
Okay, in the consumer, would you include autos as well? Because we've seen fairly good sales numbers. Stocks have been re-rated. Ashok Leyland is all-time high. We've seen big rally in Tata Motors. In the past, that's one stock that you've liked. Do you think there's comfort in some of these stocks?
So our favourite actually was Maruti, in the four-wheeler space. But because of the headwinds now coming from the yen, we moved that off some time ago. We've been more constrained towards the two-wheelers, actually, where we've been seeing more value. And that's where we've been investing in the past few months.
Okay, we don't have too many options here. We have Hero, Bajaj, TVS, and Eicher Motor, of course. Any particular?
You've named them all.
So you'll be bullish on all of them?
Yeah.
Oh wow! Okay. Well, we don't have too much time, so before we, end the conversation with you, let's talk about our love football for all three of us. What's the latest there? I hear it's Ferdinand who's going to replace Van Gaal. Is that correct?
Who?
Rio Ferdinand? Yeah, that's what I read on Twitter.
That's a new one to me. I think Mourinho is the ex-Chelsea manager is the one that we're hoping for.
Yeah.
Anyone but Van Gaal, actually.
I think they've already signed a pre-season deal with Mourinho. That's what I read.
I've read that too. I'm only hoping that it's true.
Okay.
Because I have now sadly stopped watching United play.
Yeah. I read on Twitter that Ferdinand himself put it out that he's going to replace. Maybe it's an April Fool's joke for all you know, because it is the 1st of April.
Yeah, I forgot about that.
But okay, before we get back to market, since we are in football conversation, just one last word. So Leicester or Spurs?
I think Leicester. I'm hoping it's Leicester because it would just be nice for to see a minnow within the Premier League with not having spent so much money win against all odds, I think.
Okay. So finally then, on the markets itself, I know you've been a bit cautious for a while now, but if you had to give us a view on the Nifty and on the Sensex by the end of the year, what would your realistic or base case scenario be?
So I think we'll follow earnings, and our earnings target, it's a bit of a widest range, but between 5 to 10% increase in earnings this year. So that's why I would see the index rising from here. But just by the end of the year.
Okay, just for the quarter gone by, should we be prepared for another downgrade in earnings cycle, or would we see some kind of green shoots in the Q4 earnings season?
Well, I think my 5 to 10% is way below everyone else's anyway, so I think if anything, they would have to downgrade.
Yeah. All right, Andrew. Thanks a lot for dropping by and talking to us. So that's the call from Andrew Holland. A bit cautious on the market, not because of Indian factors, but because of global factors, and more specifically because of what's been happening with Janet Yellen and the way she has changed from being hawkish to dovish. Let's take a break. As we do that, we get some market opinion that we got through the week. And after the break, of course, Ashwini Gujral will join in for some technical picks.
Our view on the fundamental is slightly more positive, so I guess we don't really see this anomaly. But in the short term, what we've seen when the markets went down and now that they're going up, mostly it has been liquidity driven. The risk on globally, emerging market, emerging markets in general have rallied, commodities have rallied. So I think we're sort of seeing that trend come through. Whether we are completely out of the woods, difficult to say, but with very sort of what's happened, if you look at last few months or few weeks even, that you've essentially seen US Fed cooling off, and the expectation on US Fed hikes have cooled, and I think that is one of the reasons why emerging markets have sort of rallied.
The consensus seemed to be far more negative than it should be. So I do think that the Indian economy is actually doing much better than what people think. And perhaps there should be that, if that's not consensus, then there is another reason to be positive about the market. Nifty and oil are positively correlated over long durations, not correlated over a few durations, but never negatively correlated. So if oil is doing badly, you will not see Nifty do well.
A very early teens kind of earnings growth in fiscal 2016, somewhere around 11 to 13%. And some re-rating, not more than 5 to 7% or so. These two things put together, we think, would propel the market about 20%. We think that the consensus earnings estimates for fiscal 16 and 17 are still significantly higher than what could be achieved. I can see consensus numbers at about 17% for fiscal 2016. I think they will have to come down, though a large part of these earnings estimate declines have already happened. We are possibly in the last leg of earnings estimate decline, and I would expect some degree of revival from the second half.
The momentum of the market is very strong. You are in the last few days of the month of March. You have an FNO expiry. The world is looking much stable at this point of time. Oil is looking much stable, and possibly, that commodity could have also seen its worst last month. I think all of these factors suggest that all dips in the market will be used by the stronger hands to buy into them. And that's the reason I believe that 7580, 7600 just for the next few days is extremely important. If it breaks on a closing basis, then maybe we will have to work with the view that this pullback extends to about 7400. But whether you buy at 74 or 7600, I think the important takeaway is that the market is now starting to make higher tops and higher bottoms, something that it's not done in the last 1.5 years.